G'day everyone, Greg Canavan here from Rum Rebellion. This week I want to talk about a few different markets. Obviously gold, there's been a lot happening there since the last time I chatted to you. As you know, we've been following gold quite closely and there's been a few developments there that I think are quite interesting and I want to get to on that front. And then obviously the continuing meld up that we're seeing in global equity markets is worth commenting on as well. And I've got a few charts from the Aussie market that I think you'll be quite interested in. But I first want to start with something different, a tweet from President Trump, which I guess is not entirely unusual, but in this case, it reinforces a couple of the points I want to make about the gold price. So let me bring that tweet up and we'll get straight to it. This came out, what was it, Wednesday night, Australian time, so during the Wednesday trading session in the US, or probably late in that trading session. And as you can see there, the tweet is China and Europe playing big currency manipulation game and pumping money into their system in order to compete with USA. We should match or continue being the dummies who sit back and politely watch as other countries continue to play their games, as they have for many years. So I guess the reason why I want to talk about this is effectively it's saying, Trump saying that, you know, the US should join in the currency manipulation game. Aside from all the other economic angles that I could go with this, effectively it's quite bullish for gold because it's adding more pressure on the Federal Reserve to cut interest rates. Clearly China, Japan, Europe, they have no interest in seeing their currencies rise in value against the US dollar. And Trump's saying we don't want to be the mugs that sit back and let you play this game while we have to deal with a strong dollar. So look, I think that's going to translate into continued strength for gold. Which let me show you this next chart now because it's a really important one. So the chart I want to show you here, this is I had this for subscribers of my Crisis and Opportunity report a couple of weeks ago, and it shows a really long-term chart of gold from the start of the bull market in 2001 up until today. It's a weekly chart, and what the lines I've drawn there, or the points on that chart, is the start of the bull market in 2001 to one of the weekly closing high in, I think it was sometime in September 2011. The important point to note on this chart is the 50% retracement level, which is marked there. You can see that quite clearly. And the bear market that occurred from pretty much from 2011 through to the bottom in late 2015 retraced exactly, or very nearly exactly, 50% of the whole bull move. This is significant because I guess in technical language, a 50% retracement of a bull market move and then a continuation of the move higher after that retracement is a very bullish move. And what you've seen, even though this is a very long-term chart, what you've seen is the retracement of 50%. Then we've had a bit of trading within a upward trending trading range over the next 3 or 4 years. And then just in June, you saw the gold price in US dollars break out of that trading range. So to me, that confirms that the bull market that really started back in 2001 took some time off for a few years to consolidate that massive big gain. The 50% retracement confirmed that we didn't really go into a secular bear market with gold. We've always been in the secular bull, and you know, this is just evidence, or the latest breakout is evidence that we're at the very early stages of the next leg up. That's reinforced by the next chart here, which is the US gold stocks. It's the Van Eck Vectors Gold Miners ETF, GDX is the code. And with that breakout in gold in June came a breakout in gold stocks. Now the difference here, gold stocks haven't moved above their 2016 highs. There was a massive rally in gold stocks in 2016. So we're still lagging that particular move, but gold stocks are breaking out above multi-year lows, which I think is a very encouraging sign. The difference between gold stocks and the general market at the moment is that stocks in general are breaking into either new all-time highs in the US or very much close to all-time highs in Australia. Now, just to put this in a bit of context, this next, it's not really a chart, but this next graphic I have for you is a cut and paste from one of the Crisis and Opportunity updates I wrote to my subscribers back. I think this one is from the 1st of May. And this is just to give a couple of scenarios to how I thought the market might have played out a couple of months ago, within the context of me saying that we're in a broader bear market. I'll just read that to you. It says, this bear market developed in 2018 and I believe will continue in 2019 and into 2020. There are a couple of scenarios as to how this could play out. One, we could get a correction now before another move higher to marginal new highs. Then the bear market should get underway sometime in the third or fourth quarter of the year. Scenario two, or you could see stocks correct lower from here for a few months, rally back to the highs and then turn down again. Scenario number three, finally, you could see stocks continue to move higher without a meaningful correction. That is an ongoing melt up that sucks more and more people in before the bear market emerges. So what we're seeing essentially in the Aussie market now is a continuation of the melt up theme that I suggested there in point three. And when I bring up this next chart, you can see that the rally right over there at the end of 2018, we put in a low and we've effectively just shot nearly straight higher all throughout 2019. And we are now approaching the all-time high of the market back in 2007. So whether this will be an inflection point for the market in terms of the exhaustion of the rally or whether it can break through that level remains to be seen. But clearly, the pace of the rally that we've seen this year, for me, it's unsustainable, and at the very least, we should be seeing a decent pullback soon enough. A pullback would be healthy. I'm not saying that it's the start of the bear market, but I am saying that the pace of the rally that you've seen, and it's just been without a meaningful pullback, and clearly that's to do with Reserve Bank cutting interest rates and saying there's more to come. There's a lot of money just stuck in savings accounts that have decided to get out and look for returns elsewhere. The next chart there just shows, zoomed in on the last couple of years, of the ASX 200, and really it's a near vertical climb. So I guess the point I'm trying to make here is that buying stocks or certain stocks at these levels, really quite risky. You're buying near getting towards all-time highs after the markets had a very strong rally without any meaningful pullback or correction, and often that's not a great time to buy. Following on from that, next chart shows the bond market. Once again, the bond prices have just melted up as well, and this is all to do with Federal Reserve, central bank, Reserve Bank policy of just being as easy as they possibly can, and getting up to their old tricks of causing asset market bubbles. Now, that's the stock market. If just go back to that chart showing the US dollar gold price there, after it retraced to 50%, gold's very different, and it's broken up from a long-term trading range that's been after a prolonged bear market. So we're in a completely different cycle for gold, which is why I'm more bullish for gold than I am for stocks. And given that bullishness, I've been doing a fair bit of research on another aspect of the gold market that I don't think, well, haven't really seen too many people talking about. It's certainly not talked about in the mainstream media. And I'm doing it, as I said, doing a research report on that I hope to have out and ready next week. So make sure you tune in, subscribe to the videos, and I'll have something for you next week with a link to that report. Okay, thanks for watching, and I'll catch you again soon. Bye.